This is the third video in this beginner's how to use options series. So what we're going to do in this video is take you through a really good trade strategy that's very simplistic, but it's an income strategy that's very well known and used by investors and traders. So what I'm going to show you is what we call a covered call. So options, though, can be used to day trade, swing trade over a few days or even weeks or months, or to invest. The example I'm going to go through is for a longer term strategy, a lot of times used by investors and even institutions for their clients. And this is called a covered call strategy, since it is the simplest strategy but will demonstrate both the buyer and the seller of a call option and how this strategy works. So for example, let's say Joe owns 500 shares of the XYZ stock that he bought for $40 a share. But he's tired of earning just a 2% annual dividend. And he's heard that you can earn income from your stock if you use what is called a covered call or a call option against your stock strategy. So here's what he does. On September 6, he sells 5 October call options that have a strike at $42.50, and he collects for giving that obligation to a buyer. He collects $1 per contract for each of these $42.50 strikes that he sells. So he had 500 shares, and he sold 5 of these $42.50 strikes against it, and he received as a credit $1. So that's $500 he gets in his brokerage account for selling this at the money or out of the money option, which is a 2.5% return in 6 weeks. Now that's a pretty good deal. That's a lot better than that 2% he earns annually in dividends. Plus he gets the dividend payment on top of that as well. Here's what this means. So Joe has given the right to the buyer of the call options to buy the stock on the third Friday of the month, or before even, at the $42.50. Here's what happens on expiration Friday. The stock, if it goes to $42, the option will expire without being exercised, since the value of the XYZ company is less than the strike of $42.50. Now remember, he owns the stock at $40. At expiration it was $42.50. He had sold the options at $42.50. So he was not exercised because it was not at $42.50 or above. So Joe gets to keep his stock, and he just made $1 contract, or $500, for selling those options against his 500 shares of stock. But what if the stock had gone to $43? What could Joe do? What would Joe have to do at this point in time? Well, he could buy the option back. On the day of expiration, the price of the option would be probably around 50 cents in this example. So if he bought that back for 50 cents, he still made 50 cents on the position. Remember, he sold it for $1. He buys it back for 50. He still makes 50 cents. So the dollar price he sold the option for minus 50 he paid for the option back equals a 50-cent profit. Now this would be a 1.25% return in that 6-week period of time, or if you annualize, that's a 10.8% return annually. And this again beats just the dividend rate of 2% a year, which he still gets anyway. So as long as Joe owns the shares, he can then sell options for the next month. But it would be smart if he first checks to see where the stock is in its short-term cycle before selling that option, so it will increase his opportunity to make more money or more income from the stock. Now we have the power cycle trading model, which is just designed as a timing model, which can help you do that too. But what if the shares of stock went to $44? It would be kind of a bummer, but how bad is it? Joe could review a short-term chart to help him make his best decision as to what he could do. So first, he could sell the stock at the strike price of $42.50. Remember, he was obligated to sell the stock at the price if the buyer chose to exercise the option, which is what he would do if the price is over that strike at expiration. In this case, though, Joe still made $2.50 a share on the stock, plus he got $500 for selling the options. That's $1 per option contract. Now this was a trade-off for missing part of the upside stock, but he made $350. So he made the $250 from selling the shares that he owned at $40. He sold them for $42.50, so he made $250 there. Plus he received $1 per option contract, so that's $350 he made divided by his basis of his stock at 40. That's an 8.75% return. That's not too shabby either. Or Joe could just buy back the option and keep the stock. He would have to take a loss on the option, probably about $1, but he sold it for $1, so it might be about a break even, or he might lose a little bit. But still, all in all, Joe broke even on the option before commission if he bought it back for $1, because he sold it for $1. He made $4 a share on the stock if he sold it at 44, and he bought the stock at 40. And he has an unrealized capital gain on the stock if he keeps the stock. And then what he can do is go ahead and sell another option contract with say a $45 strike or maybe a $46 strike for the next month or two out, and keep doing this over and over and over. So this is just the basics of a covered call. And to do this, Joe can also use some very simple technical analysis to help him maximize his returns on his investment and the covered call income. And we have what we call the power cycle trading model, which is a real great tool for just doing this. So good luck trading, and I hope you now understand a covered call. Until the next how to use option video.